Today's episode. In this episode, we will discuss about dissolution of a partnership firm. In addition to this, we will also discuss rectification of errors. I am Dr. Arshia Hussain, PhD in Human Resource Management and teaching in the Center for Management Studies, Jamia Millia Islamia University, New Delhi. So let us start with the meaning of dissolution of a partnership firm. Dissolution of a partnership firm means that the firm comes to an end and ceases to function as a firm. On the dissolution of the firm, the assets of the firm are sold and liabilities are paid off, and out of the remaining amount, the accounts of partners are settled. Any partnership may be dissolved on account of any one of the following reasons. First one, dissolution by agreement, when all the partners give their intention to dissolve the partnership firm. Second, compulsory dissolution. Under this, the first one, when all the partners or all except one partner becomes insolvent. Second one, when the business of the firm is declared illegal. Third one, when all the partners except one decide to retire from the firm. Fourth one, when one of the partners becomes the citizen of an enemy country. Fifth one, when the purpose or the venture of the partnership firm is completed. Third one, dissolution by notice, when the duration of the partnership business is not fixed and is at will, then any partner may dissolve the firm by giving notice in writing to the other partners. Fourth one, dissolution by court. The court can order for the dissolution under the following circumstances. The first one, when one of the partners becomes insane. Second point, when the business of the firm cannot be carried on or at loss. Third point, when a partner becomes permanently disabled to run the business. Fourth one, when a partner is guilty of misconduct. Fifth one, when a partner intentionally commits breach of agreement. Sixth one, when a partner transfers whole of his interest in the firm to a third party. Seventh one, when the court thinks it is necessary to dissolve the partnership business. In order to close the books of the firm on dissolution, the following accounts are opened in the order as given. First one, realization account. Second one, partners loan account. Third one, partners capital account. The first one, realization account. A realization account is opened for disclosing of all the assets of the firm and making payment to all the creditors. It is a nominal account, and the objective of making realization account is to find out the profit or loss on realization of assets and payment of liabilities. Second one, partners loan account. If the partner has given any loan to the firm, his loan will be paid off after all the outside liabilities are paid in full. The third one, partners capital account. After the transfer of profit or loss on realization, undistributed profits, reserves, etc. to the capital accounts of the partners, partners capital accounts is then prepared. Let us take a look at this illustration. Jay, Sai and Ram were in partnership, sharing profits and losses in the ratio of 3:2:1. Their balance sheet as on 31st December 2015 was as follows. The balance sheet. It was agreed to dissolve the firm, and the terms of the dissolution were: the first one, Jay took over buildings at book value and agreed to pay off creditors. Second one, accrued interest was not collected, whereas there was a contingent liability of rupees 600 which was met. The third one, other assets realized: plant rupees 25,000, stock rupees 5,000, debtors rupees 4,600. The fourth one, realization expenses rupees 600. Now prepare realization account, capital account and cash account. The solution to this illustration is, first of all we will make realization account, then we will make capital accounts, then we will make cash account. When the partners are insolvent and are not able to bring the amount due from them, then the creditors of the firm cannot be paid in full. In such a case, the creditors of the firm will be paid all the cash available together with whatever can be received from the private properties of the partners after the expense of the realization are met. The capital accounts will be closed according to Garner versus Murray rule. Alternatively, creditors may not be transferred to the realization account, but their separate account may be prepared. If this is done, unpaid amount of creditors is transferred to the deficiency account or unpaid account, to which account are also transferred the balances of partners' capital accounts. The deficiency account shall be automatically closed and the books will thus be closed. The next illustration, A, B and C are three partners sharing profits and losses in the ratio of 2:2:1. They decide to dissolve the firm, and following is their balance sheet on the date of dissolution. The assets realized as follows: stock rupees 11,400, sundry debtors rupees 1,200 and furniture rupees 2,400. Plant and machinery is taken over by A at rupees 12,500. Creditors were paid off in full. A contingent liability for bills receivable discounted materialized to the extent of rupees 400. C is insolvent, but his estate pays rupees 2,400. Give accounts to close the books of the firm. First one, if the capital are fixed. Second one, if the capital are fluctuating. Now the solution to this. The first one, if the capital are fixed. First of all, we will make realization account. Now the second one, if the capitals are fluctuating, there will be no difference in realization account, so it should not be prepared again. Cash account, thus the ratio of capitals is 26,000 is to 16,000 or 13 is to 8. We will see another illustration. The balance sheet of X, Y and Z who were sharing profits in 3/5, 1/5 and 1/5 is stood as follows as on 31st March 2015, that is the dissolution. Then partners capital account, which are X capital account, it is important to note here that the deficiency of Y is transferred to X and Z capital account in the ratio of their capitals, that is 3:2. As X and Z are also insolvent, the surplus of rupees 600 in Z capital account is transferred to X capital account. Now, the next topic that we will discuss is rectification of errors. We know that financial statements are prepared on the basis of books of account. The financial statements provide information about the performance of an organization to management and other user groups. If such information is not error-free, the users will be misled and may take wrong investment decision. Thus, it becomes necessary to identify and rectify the accounting errors. An error means not following the accounting procedures and norms. In other words, if in books of account the elements or features of correct accounting are not followed, then an error has been committed. Such errors need to be rectified, otherwise the final accounts, which includes profit and loss account and balance sheet, will not show the true and correct position of the organization. The different types of errors are: the first one, errors of principle. These errors are committed in applying some accounting principles. For example, treating a revenue expense as capital expenditure and vice versa. Second one, clerical errors. These errors are committed in applying accounting procedure. Clerical errors are of three types: A, error of omission; B, error of commission; C, compensating errors. Error of omission means when an entry is completely omitted from the subsidiary book. For example, sale of rupees 10,000 to A on 31st January 2015 is not recorded. Error of commission means when wrong amount is written in the subsidiary book. For example, purchase of goods worth rupees 5,000 from X is entered in the purchase book as rupees 500. Compensating errors means when two or more mistakes which compensates the effect of each other on trial balance. Under this error, the trial balance will agree. For example, excess debit rupees 1,000 to furniture account and excess credit of rupees 1,000 to sales account. Rectification means bringing to the correct position whatever wrong has been done. Rectification can be done in two ways. First one, before preparation of trial balance, that is, without opening a suspense account. Second one, after preparation of trial balance, that is, after opening a suspense account. When a trial balance does not tally, the difference is put to an account named as suspense account. The difference is either debited or credited. With the help of suspense account, trial balance is artificially tallied. While passing rectification entry for one-sided error, the one effect, debit or credit, will go into account in which mistake is committed and the other effect will be given to suspense account. When all such one-sided errors are rectified, the suspense account will become nil. While rectifying double-sided errors, suspense account will not be affected. The steps for locating difference in trial balance are: checking all documents or vouchers to find out that all documents are entered correctly. Checking bank reconciliations. Similarly, checking balances or full accounts with major parties such as debtor, creditors, loan account and so on. Examining the ledgers to locate if there is anything missing. Applying ratio test, comparison with previous year data and so on. Rectification of errors can be divided into two parts. Rectification of two-sided errors, that is first one, and the second one is rectification of one-sided errors. The first one, rectification of two-sided errors. These errors do not affect the agreement of trial balance. That is, despite of such errors, trial balance can agree. In other words, such errors do not cause any difference. For example, A, credit purchase of rupees 5,000 from ABC Limited was not recorded at all in the books. Now, this is an error of complete omission. The general entry in this case will be purchase account debit rupees 5,000 to ABC Limited account rupees 5,000. B, credit sale of rupees 7,000 to X was recorded as rupees 17,000. Now, this is an error of recording. In this case, the wrong entry will be X account debit 17,000 to sales account 17,000. The correct entry will be X account debit 7,000 to sales account 7,000. And the rectification entry is sales account debit by rupees 10,000 to X account by rupees 10,000. Now the second one, rectification of one-side errors. Rectification of one-sided does affect the agreement of trial balance. The difference of trial balance goes to suspense account. Rectification of one-side errors depend upon the stage at which errors are rectified. That is, A. Rectification before the preparation of trial balance, and B. Rectification after the preparation of trial balance. Now let's see some of the examples on this. The following errors have been located. Rectify them: A. Before the preparation of trial balance, and B. After preparation of trial balance. First one, purchase book was overcast by rupees 1,000. Second one, sales book was undercast by rupees 2,000. Third one, credit purchase of rupees 10,000 from JCK Limited was not posted to their account. Now the solution. A. Before the preparation of trial balance. The first one, purchase book was overcast by rupees 1,000. Now this is an error of casting. Thus, on the credit side of purchase account by overcast of purchase book rupees 1,000. Second one, now we will see the next one, that is sales book was undercast by rupees 2,000. This is an error of casting. On the debit side of sales account to overcast of sales book rupees 2,000. Third one, credit purchase of rupees 10,000 from JCK Limited was not posted to their account. Now this is an error of partial omission. On the credit side of JCK Limited account by omission in posting rupees 10,000. Now second, after preparation of trial balance. The first one, purchase book was overcast by rupees 1,000. Suspense account debit to purchases account by rupees 1,000. Second one, sales book was undercast by rupees 2,000. Sales account debit 2,000 to suspense account rupees 2,000. The third one, credit purchase of rupees 10,000 from JCK Limited was not posted to their account. Suspense account debit rupees 10,000 to JCK Limited account rupees 10,000. Now let us see some more examples on rectification of errors. A bookkeeper finds the difference in the trial balance amounting to rupees 1,000 and puts it in the suspense account. Later on, he detects the following errors. First one, purchase goods from Ravi rupees 15,000 but entered into sales book. Second one, received one bill for rupees 25,000 from Arun but recorded in bills payable book. Give rectifying journal entries with full narration and prepare suspense account. Effect already given in account. Ravi account debit rupees 15,000 to sales account rupees 15,000. Second one, Arun account debit rupees 25,000 to bills payable account rupees 25,000. Third one, Harish account debit rupees 25,000 to cash account rupees 25,000. Now the correct effect. The first one, purchase account debit rupees 15,000 to Ravi account rupees 15,000. Second, bills receivable account debit rupees 25,000 to Arun account rupees 25,000. Now the rectification entry. First one, purchase account debit 15,000, sales account debit 15,000 to Ravi account rupees 30,000. Second one, bills receivable account debit rupees 25,000, bills payable account debit rupees 25,000 to Ravi account rupees 50,000. Now let us quickly summarize what we learned today. We discussed the meaning of dissolution, modes of dissolution, errors and their types, and rectification of one-sided errors and two-sided errors. Dissolution of a partnership firm means that the firm closes down its business and comes to an end. A partnership may be dissolved on account of any one of the following reasons: dissolution by agreement, compulsory dissolution, dissolution by notice, and dissolution by court. We also discussed rectification of errors. It means bringing to the correct position whatever wrong has been done. There are different types of errors: errors of principle, clerical errors, errors of omission, error of commission, and compensating errors. So that is all for today. Hope you have understood. We will see you with another topic in the next episode. Till then, take care. Goodbye.